Welcome to the episode 16 of Startup Strikes. Today, my guest is Jake O'Shea. Jake is a VC investor and a principal at Antler, the world's day zero investor, enabling exceptional founders to build startups and great companies from the very beginning. Welcome, Jake.
Thanks for having me.
Of course. Jake, I'm just going to start with the more of like a background question because I'm really curious about your educational and professional background and your transition to the world of VC. So, what inspired you to pursue a career in venture capital? And also just tell me about your background as well.
Sure. So going way back, grew up in Kingwood, Texas. It's a suburb in kind of the northeast side of Houston. And I think the number one thing that kind of led me on this path to venture capital and startups was that in high school, I was a huge debate nerd. So I did competitive debate, won awards at a state, national level. And what debate taught me was really arguing both sides of any issue, right? And the importance of framing and just ideas and getting ideas out into the world. So in competitive debate, you're given a topic like gun control or voting rights or XYZ. And you have to both have a pro case arguing for that topic or resolution and a con case arguing against it. And so, in high school, I got super into that competitively. It really taught me to kind of take both sides of an issue and also got me really excited about ideas, specifically ideas that would impact the way the world works. So when it came time to go to college, I got accepted into UT in Austin, studying government and political science. So still, interested in this realm of ideas and impacting the world, but more on kind of the government political side. That was what a lot of debate topics were focused on. So came to school at UT, was in my first year taking some of my initial government classes. And then that summer, the summer of 2016, I got an internship at a local super PAC, political action committee. And it was summer of 2016. So first version of Trump v. Hillary, very high tensions, lots of strong emotions on both sides, and also like kind of a whole new world. 2012 election wasn't like this. 2008, like things had ramped up quite a bit. And during that internship, I actually really enjoyed the people I worked with, and the work itself was a lot of just dialing representatives, being like, where do you stand on these issues? These are kind of the issues that we support. How can we work together, et cetera. One thing I noticed was that the name of the game in politics is to get the other side upset. And if the other side is upset, they'll donate to your side. And that's ultimately the business model of government organizations. And so while there was this aspect of like debating ideas and trying to talk about what the future of the world looks like, I was always very keenly aware that the real job wasn't actually to implement those ideas or to get those ideas passed. The real job was to talk about how much better your ideas are than the other side, so that people that agreed with you would give you their money, and you would then be able to theoretically use that money to implement those policies. But given the structure of our government, they don't implement a lot of policies at all. So all of this is kind of a roundabout way to say I left that internship feeling pretty cynical and disillusioned with government as a career path. You can advocate for great positions and great ideas all you want, but unless you can actually implement those ideas, it doesn't matter. And I don't see any, or didn't see, still don't, I guess, ideas getting implemented on a national scale via the government. So, with that in mind and a government degree, there's not a whole lot of job options. I was in the liberal arts school, not really known for kind of career expansion or helping you find a job out of college, but I still knew that I really liked ideas and I wanted to find some way to impact the world. So I basically went to taking random internships wherever I could. Basically any open internship. I think I ended up doing 4 or 5 of them. None of them were paid. All of them were kind of just like, hey, so-and-so needs help, more of kind of like a executive assistant or like chief of staff type role where it's like, hey, there's an executive director that runs this nonprofit digging wells in Ethiopia. That was the first one that I did. He needs help figuring out how they can raise money and how you can dig more wells in Ethiopia. And then another one was at a local startup called Brogue, which makes a bra-robe combination garment for women recovering from breast cancer. Because it's really difficult to manage a lot of the drains and tubes that you have post-surgery. So then the third one was a company called Logix, which was like legal tech, AI automation. And I think the common thread in all of those was, one, I loved working on small teams. I loved the idea of you kind of work to the level of your competence rather than like, oh no, you're a marketing intern. Your job is to make this newsletter once a week and that's it. I really like the creativity in more of the smaller teams, and especially in the startups. They just had a bunch of problems. And if you solve one problem, they'll give you another. And there's really kind of no end to it until you hit a problem that you're not able to solve. And so once I had that internship with Logix, which was kind of midway through my junior year, I kind of realized, okay, like startups are really cool. How do I work with startups? I love that, they're building their ideas, but I also love that they have full control over how that's implemented. People don't need to vote for it. If they build a better solution and they can get customers, then they can change the way the world works just by, essentially having the better idea and then executing and implementing it. So that was kind of what initially attracted me to startups. Once I figured out that that's the area I wanted to work professionally in, I started trying to network however I could. And, as a college student, that meant joining clubs and going to events locally in Austin. A bunch of those events were hosted at a VC firm in town called Capital Factory. And one of the clubs I joined was called Genesis, which was a student-led VC fund. So they had, everything from deal flow to due diligence to portfolio management to events and awareness, driving applications of new companies, et cetera. And while I was there, an alumni mentor in that program was also working at Capital Factory, where I had been going to lots of events. And so, started working with him, mostly doing events for the student-led startups that the Genesis Fund had invested in, and realized that I really loved kind of working with founders and trying to connect them with relevant people to solve problems. So at Genesis, I was connecting them with local marketing experts to figure out how do you run a marketing campaign, or local lawyers to say, hey, what are the kind of ins and outs of filing patent protection, things like that. And so when it came time for me to find a job, I was looking at basically any open role at Capital Factory, the big startup community that I knew of. And that mentor that had kind of worked with me at Genesis Fund had been working at Capital Factory for a little while and said, hey, there's this new team called Investor Relations that I just got approval for. We're going to start hiring an associate here in the next couple of months. Like, I'm not sure if you have anything lined up, but would love for you to apply. And at the time, it was like March of 2019 when I was graduating. So I was like, I'd love to apply, but like I need to kind of find a job. So it was kind of applying around. But thankfully, like none of those applications ended up working out. I was just applying for any kind of open analyst, associate role, or also a few roles like just at local startups. Just trying to kind of be close to that ecosystem. And again, to that small team and like independent vibe that I had really realized that I had grown accustomed to and enjoyed. And so, thankfully it was still, hadn't locked anything in and was able to apply for that job at Capital Factory, ended up getting that job. And that was kind of how I entered the VC startup scene initially, was in investor relations, which really at Capital Factory meant helping their portfolio companies. They today probably have like 500 portfolio companies. Back then it was like 300, helping those portfolio companies raise money from external investors. So it was a great role because half of the role was talking to founders and helping them prepare to fundraise, providing tools, templates, like actionable strategies that they can use to more easily raise money from venture capitalists. Then the other half of the job was working with VCs and understanding how do they evaluate companies, what's their average check size, what areas do they focus on, how do they underwrite founders, what do they look for in potential investments, and then kind of playing matchmaker. So I got to see kind of both sides of that equation, and super valuable experience for me. I think the second thing on top of that was Capital Factory had a lot of, I'd say, legacy operational infrastructure. So there was no easy way to like query portfolio companies and build a list for me to send to investors. And there was no easy way for me to, query our investor database and build a list of that and send it to the founders. So had a lot of just operational areas for improvement. And that was a lot of the tasks and projects that I had been doing at the internships. So started looking at, okay, how do we make the whole machine more efficient and run more effectively? So ended up building us a new database, moved all the data into there, ended up eventually graduating from that database into Airtable, like a custom built solution that I had mapped out. And ultimately, we got the entire company to move over to Airtable as kind of their backend data infrastructure and running a lot of the operational pieces. And so, one, I learned about myself that I really love kind of the system building aspect of running a business. In this case, it was an accelerator, but you can apply it to any business. But at the same time, was able to get promoted a few times and eventually basically like manage how the accelerator program interacted with portfolio companies. So our mentor program, our investor relations program, At the time, they had a VIP program. I got funding for like a platform associate to do a lot more of like the operational nitty gritty stuff, and really loved that experience. So spent about 3 years there. Then had the opportunity to go work at Foundation Capital, which is a Bay Area pre-seed and seed enterprise software, fintech, and crypto firm. Was super excited just to see what more traditional venture capital looked like. Capital Factor was more of an accelerator. It was small follow-on checks. Foundation was, a 30-plus-year-old institutional venture firm, investing $2 to $5 million as a company's first outside financing. So the opportunity there was to really build out and shape what their portfolio operations platform, team, and function looked like. So spent a couple of years there, really focused on, again, like building out a lot of the operational infrastructure for who's in your network, how you track intros, how you structure relationships with different executive advisors, customers, angel investors, et cetera. And then also, recruiting those executives and trying to create systems where you could make customer introductions, angel investor intros, just generally add value to portfolio companies via leveraging that network and a lot of that operational infrastructure. So really enjoyed that. Again, learned a ton specifically about kind of enterprise infrastructure, a little bit about fintech and crypto, but also how institutional VCs really do their job, which is a lot more about like winning allocation in the best deals and really identifying this outlier, like the top 2 founders in any given space, and then finding a way to back them if they have an interesting business idea. So loved that. And then now at Antler, I've been here for about 5 months now, joined midway through January of this year, 2024. And this is kind of the perfect fit for me, especially coming from that starting at Capital Factory, recent experience at Foundation. At Antler, I'm a principal, so full-time on the investment team. But the job and the work that Antler does is really very hands-on with portfolio founders. So a lot of that expertise, a lot of the tools and templates that I've built out, a lot of the operational things that I've learned, I get to actually roll my sleeves up and get in the nitty-gritty with founders. And then at the end of that, get to really advocate for founders and ultimately end up investing their first $500,000 into that company via Antler. So super long-winded answer, but that's kind of my story, where I came from and how I landed here.
No, this is extremely useful and helpful. And actually, it's kind of created. I have some questions on the side just to guide me, but it's created some questions that I want to ask. What does Antler do differently compared to like more other typical VC funds? And what do you like? What aspects do you really like about your VC work? Right, you said there are your practices, right? There's sourcing, there's due diligence, there's portfolio management, et cetera, investor relations. What do you like the most?
Yeah, great questions. So what Antler does is we provide institutional VC backing before pretty much any other firm will.
Mhm.
And what I mean by that is we run a founder residency twice per year. So kind of a cohort-based model similar to like a YC, a Techstars, 500, et cetera. And we bring in per location. So we're based in the US in Austin, New York, and Boulder. But we've actually got 26 locations globally. We bring in between 80 and 90 really high quality founders. These are people that haven't started building anything yet or have been building for, a few months, maybe have an MVP, but haven't started, really hitting that kind of venture growth scale or venture growth cycle. We work with them for 8 weeks and then we invest in the folks that we have the most conviction in at the end of the program. So in terms of what makes Antler different, I think that's the biggest thing is that we invest at the end of the program rather than coming in. What that enables us to do is work with a lot more founders, but also get to build a lot more conviction where we're actually sitting side by side with these founders, meeting with them for hours each week, learning about them, learning about the business, the way that they think, the progress, the industry, et cetera, and then using that to make informed investment decisions. At the same time, for founders, they get to build a network of really, really strong founder connections that will be future partners, future hires, future friends. At the same time, they get access to us, the investment team, and a lot of the benefits that we provide to cohort members in terms of tools, templates, discounts, all that stuff. It's completely free. We actually pay founders to come here. If they relocate from out of state, we provide a founder relocation stipend. So for those that we invest in, this is a really great way for them to get their initial funding. It's pretty significant. We then also help a lot with downstream investor introductions. We provide follow-on capital. We have follow-on capital from the seed round all the way through the exit or growth rounds. And for those that go through the program but don't get the investment at the end, they build a really awesome network. They explore a space for 2 months and learn a ton. And have a lot of great relationships, and ultimately leave with a better understanding of themselves and of what it looks like to build that business and take it to the next level. So that's a little bit about Antler. And then to your second question, like what part of the VC job do I personally enjoy the most? I'd say for me, it's kind of twofold. One is on the front end, just talking to really exciting founders about ideas. And specifically, I like getting into the nitty gritty of like, okay, what's your landing point? How do you land and expand and build a big business here? But then long term, what are the different directions strategically you can take this business? Are there adjacent customer sets that you can sell into? Are there similar products you can sell to the same customer set? Like getting really into the high level strategy of the ideas behind it. I think like, again, going back to what got me into this in the first place, the ideas are just so cool and so different. And, one day you'll talk to a company that's doing 3D printing for shoes. The next you're talking about multi-omic testing to test DNA, RNA, and protein all simultaneously. It's just really fascinating ideas. And the founders are really the experts on the ideas, but I get to kind of be this fly on the wall and learn a ton about the industry and about their product just by listening to them and kind of sharing what I've seen is effective or not effective at other startups and then aligning on a strategy. So one is just, at the front end, talking about the ideas, the strategy, things behind that. And then the second piece is just the portfolio management aspect, right? So, okay, you need help fundraising. Great. Let me dig my sleeves in and let's build you a template that helps you understand your fundraising narrative. Oh, you need to, get better with your outbound. All right, let's figure out what's your tool stack for outbound. How do we make this efficient and effective for you who's doing founder-led sales to, reasonably take 10 to 20 customer calls per week and really start building that top of funnel ahead of time. Those are the two areas that I get really jazzed about. One is like high level ideas strategy. And then the second is post investment, rolling up my sleeves. Like, how can we take actually actionable things like a tool, a template, just any of these frameworks that I've learned or developed over the years and now implemented and take the business from here to where it needs to be, which is more over here.
Um, it's just fascinating. One question I'm curious about is, I've seen some great VCs come from, very non-traditional backgrounds, studied international relations, studied, like yourself, politics or history or something like that. But also they've made great investments in like tech space, right? And, obviously some consumer, technologies don't really require any tech expertise. And obviously there goes a lot, you need to focus on the team, you need to focus on the market size and et cetera. There are a bunch of factors, yeah, you take into consideration when evaluating companies and ideas. But how does a VC investor that doesn't really come from a technical background, like didn't, work in the CS industry or studied CS, whatever, how does they manage to really find and invest this good and and manage to exit these great technical companies?
Yeah, I think different investors take different approaches. The the benefit is that there's tons of great research online,
Mm.
especially with new AI tools like stuff like Perplexity, where you can assure that you're not getting tons of hallucinations. You can really learn a ton about a space or a technology or an industry just by doing a bunch of reading and a bunch of research. So that's something that I try to do regularly is just stay in tune with new trends. What are kind of recent white papers or new research in AI or generative AI that I can read and understand at a very very high level, not at a deep technical level, just to understand like what is and isn't possible and what's kind of in the research phase versus what's ready for prime time getting put into production right now. Personally, I think the last thing that I try to do just to and I guess taking a step back too, the technical piece of it is really just like one third of the types of things that you underwrite as a VC. One is tech risk, obviously, like can they build this technology and can this technology do what they claim it can? The second and third, though, the second is market risk, right? Will people buy this as a product and will enough people buy this as a product to drive venture scale returns? But the third piece is actually the hardest, which is execution risk, which is
Mhm.
like, okay, the tech is feasible and the market is big. Like, are these founders the one that are going to be able to productize this, take it to market, and then scale it really significantly, really quickly? And that's really tough to underwrite as an investor. You kind of just have to get to know people. You have to be able to see a lot of founders and start pattern matching. And then you have to have some of these like tricks of the trade where you can help them find that first million in revenue and then go from 1 to 10 and then 10 to 50 and 50 to 100 and things like that. But going back earlier, like to the tech piece specifically, one strategy that I try to employ is like just build stuff with technology to understand one, like how hard it is and help you resonate better with founders and entrepreneurs that are either building it themselves or, have a CTO that's building it himself, whatever. Just kind of understand like it's not as easy as, oh, you just write code and then you hit play and then like anyone on the internet can access it. Like this stuff's really complicated and really difficult. And even with all these advances and making coding easier, it's still super complex and a very technical skill. So one thing that I've been doing for the last few years is just coding basic applications with Python. So for a while, couldn't really get much done because it's difficult to debug, right? You get an error and it's like you don't have a ton of context as to why that error exists. And it's a syntax error, but you didn't formally learn the syntax. You're kind of just figuring it out based on online stuff. And so it was really hard for a really long time. But with tools like ChatGPT and Replit, that's a platform that I use like almost every day. It's super easy to generate like a first draft of the code to get you like halfway there. And then once you know kind of the basics of how to iterate through variables and how to ping an API and then transform data and then create new things with the data, then it's about kind of mixing and matching that. And if you can actually build very basic applications, that to me has been a way that, I can understand a little bit better kind of what's BS versus what's real, where, if I talk to a founder and they're like, yeah, we've got this novel architecture for our chatbot. We've got like a vector database that pings over to a knowledge graph and then it outputs it and we pick the best output and all these things. And like the barometer that I use is, could I build it? And if I could build it, it's probably not technically complex, which isn't a reason at all that you wouldn't be interested in a company or a business or a startup. But it's not really a differentiator if someone with a government degree can code it themselves, So that's one of the strategies I use.
No, this is very interesting, the hands-on experience. One thing that really caught my attention, you said one sort of is tech, but also this is obviously the market risk, but also the execution part, right? And the founders are obviously the core of that execution. You've been in the VC space for a while now. What do you see as common denominators of successful founders? What qualities, what like approaches do you see that makes them really end up being successful founders?
Yeah, I mean, a lot of it is not unique, right? Like you hear stuff like grit and hustle and like all these like very ethereal things, but I mean, ultimately, like patterns that I've seen similar in lots of founders, and specifically the founders that I'm most excited about that I think have the best chance of success. One is just really thoughtful and really intelligent, right? They think from first principles about everything. They go a layer or two deeper and ask the question of like why, and then they ask why of the why to like really get down to this first principles level of thinking. And then they're just wicked smart. They make connections other people wouldn't make quicker than other people would make them. So that's one piece, is just really, really sharp, well thought through and intelligent. Two would be like really kind of maniacal in terms of the execution. They're constantly talking to customers, constantly talking to potential hires, just really like going out there, hitting the ground, trying to figure out what their customer wants, what they're currently getting, what are the gaps in there, how can they fill those gaps, trying to be creative with how they get in front of people, like really just being obsessed and maniacal about actually going in and getting in front of customers primarily. I think a lot of people really focus on the building aspect when they should really focus on like talking to customers so that you make sure that you build the right thing and don't try to like take a product and back into the customer. Start with the customer, figure out what they want and how you can provide it with a value proposition. The tech and product piece is just a way to encase that in a scalable way. But before you get to the tech of the product, make sure you have that clear customer desire value prop chain. So those are two of the things that I've just seen in pretty much every founder that gets me really excited.
I see. Let me ask a similar but a different kind of question. You already mentioned one, but I'm curious to hear, is there any other? What common mistakes you see founders make in early stages of their startup? What are common mistakes?
Yeah, I mean, I touched on the last one in my prior answer. Number one is just building a product before you have conviction on the core customer desire value prop loop. And like just to dig into that a little bit more, like every founder has some sort of like sandbox or space that they like to play in, right? So for you, it might be VC and podcasts, right? For me, it might be like AI and operations, whatever that is. That's what keeps us coming back, and that's what's driving us. That's the fire, and why you're building a company or building a startup, right? After that, within any given space, there's a bunch of different potential customers, right? And it's really important to not commit to one early on because each customer has a different list of different desires or problems that you can solve for them. And each of those desires or problems has a bunch of different value props that you could use to address that problem. And as you go each step down the road, it's like a tree, like a decision tree, and the tree branches out exponentially, right? So you have customer 1, 2, 3 to the end, right? Then you have desire for each customer 1, 2, 3 to the end. And each desire problem has value prop 1, 2, 3 to the end. So if you lock in any of those variables before you have strong conviction, you'll end up just spinning your wheels and you won't make any progress, right? So I think the big problem that I see lots of founders making is they will build a product first and try to like back in or intuit their way into that customer desire value prop loop, or they'll focus on the wrong customer, right? They'll think, oh, I want to build a product for oil and gas. I'm going to sell to the oil and gas producers like the Shells and Chevrons of the world. And like that might be the right approach, but before you commit to building for that customer segment, talk to all the potential customer segments because there might be a more clear need and a more clear business in one of those other customer segments that you haven't thought about. And so that I think is the number one mistake that I see founders making is that they have an idea, maybe they experienced a problem themselves that they want to go out and solve, and they just jump straight into building. When really at that point, you should go interview a ton of people with the same profile as you, the person that had the problem, but then figure out who are the other 2 or 3 potential customers in this area that I could be building for and start talking to them as well and see what common things emerge. And that's going to help you narrow in on that customer desire value prop loop quicker. And if you have conviction in that and you have that flywheel going, then the technology, the product will kind of build itself or provide its own roadmap because you've got this really, really clear delineation between the customer, what the customer wants, and then how you're going to help them get what they want. That's then how you build the product.
That's fair. That's really interesting. So one question I have is, like the AI and the machine learning has been around for a while now, but obviously it was OpenAI, there was a boom, right? The ChatGPT kind of like was a change the landscape quite significantly. And now we're seeing rise of like bunch of AI companies that, even some companies just add AI to increase the chance of, getting funding. How do you, I mean, you already touched up on your sourcing kind of briefly, but how do you find and evaluate as this really cool companies before they even become like trendy? What do you, like, obviously there's a lot of intuition element and sometimes very successful VCs miss out on really good deals. But like besides the intuition part, how do you like try to see, especially if the market like AI market might be getting a bit saturated with rise of bunch of startup companies, how do you determine which one is gonna be actually like a pretty good instead of just being another AI company?
Sure. That's the secret sauce, right? That's what every VC, specifically the kind of pre-seed stage VCs, that's the name of the game is how do you find these great founders before they actually formally start building publicly, sharing with the world what they're working on or what they're doing. Because at that point, if you're a pre-seed fund, you're priced out or they have options that have, huge brand recognition or can basically like pay up and give you a much higher valuation than a firm like Antler is able to offer. So I'll say like 2 things. One is that I think every company is an AI company, right? Like if you were building in 2010 or 2011 or 2012, you might say like, oh, we're a cloud startup, right? Meaning we're like building on one of these open cloud providers like Microsoft or Google or AWS. I don't even know if all of those were around back then. But now today, it's like, that's just how you build a startup. And that's what's happening with AI, right? What ChatGPT did was they made it as easy as pinging an API to leverage the power of this really, really expensive to train in terms of the data and just to compute AI model. And then spurred all this other innovation. And now there's a bunch of different options, et cetera. So I think every company is an AI company in some capacity, meaning they'll either have some certain features that are powered by these new AI things, or they'll just build their solution using something like GitHub Copilot, which is AI, right? Or Replic's AI Ghostwriter, which will help them be more efficient and effective. They'll prepare marketing materials or blog posts or whatever using AI. There's
Mm-hmm.
going to be AI in some form. So when it comes to like evaluating what's actually going to be new and unique and interesting, uh, if it's some sort of novel AI architecture or platform or things like that, that's stuff where I need to outsource it. I need to go talk to heads of engineering, heads of AI, heads of data at larger companies, basically say, hey, here's what they're building. Here's like high level, the problem that I think it solves. Like, I guess maybe that's one thing is I need to understand the customer desire value prop loop. And you can understand that without knowing any code at all, because that's all just very high level like business. But then to go a layer deeper of like, is this feasible? Is this reasonable? Is this realistic? Are there better approaches? That's where you have to leverage networks and leverage other people that are smarter than you. So trying to get in touch with these folks is definitely a big part of my job, to basically just say, hey, I'm looking at this company. Like, what do you think? Does this seem reasonable? Does this seem valuable? Is there better approaches that, would make this one kind of outdated or unusable? That's a big way to do it. And then second, like, how do you find these people? Um, that ultimately is the job of the VC, and everyone has different strategies for it. So Antler, thankfully, has built a big, reputable global brand. So we've got a lot of inbound, but we found that the majority of our investments actually come from outbound. So from us identifying, hey, this person has criteria we think would make them a strong entrepreneur, a strong founder. Let's reach out to them, make them aware that Antler exists. And then if they're interested in planning on starting a company, let's make sure that they come in and start it with Antler so we can be their first investors and really earn the ability to invest by working closely with them and helping them short circuit the first 6 months of company building and have them do it in 6 weeks. So some strategies that I use are a lot around like events and trying to find local engineering communities. So here in Austin, I run an AI community called AITX. We have about 100 people come out each month. It's pretty open. We showcase local AI startups and help them do demos. We also will fund other local community organizations that want to do AI meetups. So like tomorrow in the Antler offices, there's a local engineer. He wanted to do AI co-working, which is just like, hey, get people building with AI, hacking on side projects. Like, let's put them all in a co-working space so that they can meet each other and also help each other with what they're building. So through AITX, we've been able to actually fund them to buy breakfast tacos and help them secure that space and help them promote it to our network of newsletter subscribers and people that come to the meetup. So trying to just amplify a lot of those community initiatives so that, I'm meeting these great entrepreneurs as they're starting to think about starting a company or, are hacking away on a side project that maybe has legs as a full scale venture business. So that's one strategy I use on top of like a bunch of others that I don't really want to dive into, but there's a lot of kind of figuring out what are the archetypes that make strong founders, and then how do you identify that at scale, and then find some way to get in front of them to let them know, hey, Antler's an option. If you're starting a company, we'll be your first investor. There's no cost to attend. All you do is meet a bunch of other great founders, learn a ton about building a huge startup, and if you are one of these kind of like top 10% of the founders that we bring in, we'll then give you significant capital to go work on it full time and support you in that process.
Mm-hmm. Um, this is really interesting. So, you know, you are interested in, definitely seems like you're really interested in AI. What applications of AI, what sectors you're really interested in? And also, what do you think are going to be the kind of like the big things in the coming years? And alternatively, different question would be, do you believe like certain sectors would like start to die out, right? Like start to, like, for example, I've been hearing some stuff about B2B SaaS kind of like losing a really momentum and significance. What are your thoughts on that?
Yeah, definitely super interested in AI. Foundation Capital has been investing in that space since 2012 pretty significantly. They were the first investors in a local company here in Austin called Jasper AI, which is now a unicorn. They were the first institutional firm to invest there. And so I was seeing a lot of this while I was working there before it was kind of public, before ChatGPT launched and the public was like, oh, this is like actually pretty magical. I was in OpenAI using their sandbox, which was like kind of the early version that you could test the API, see what the output was, etc. So I actually think the space has gotten a lot more noisy since then, because like to your earlier point, everyone's an AI company. To
Mm,
my thesis, like every company is going to integrate it in some level. In terms of like applications that I get really excited about, I actually think about it a lot less in terms of different applications and a lot more in terms of the opportunities that I see are one in creating these hyper verticalized platforms. So when you think about the 2010s and like the last decade of startups, they were dominated by these horizontal solutions, right? Databricks is a horizontal data lake platform. Slack is a horizontal communication platform. What I mean by horizontal is that it's not built for architectural engineering. It's not built for oil and gas. Any type of business can implement this. Salesforce, another great example. I think that when you think about the way that AI is most effective, it's when you can have it hyper focus on some certain subset of the data. So you can do that by fine tuning a model. You could also do that with some sort of vector database or retrieval augmented generation. Or you could do it with like a fine tuned open source model. Like there's a lot of ways, but ultimately what you're doing is you're saying, hey, you've got this generalizable model. Let's focus the output on this specific area. And in order to do that effectively, you need a ton of data specific to whatever type of output you're trying to get. And companies have a lot of that internal. And so I think there's a huge opportunity to build a new version of some of these horizontal platforms, but that has a bunch of specific areas that are unique to a specific industry, and do that using AI because of the way that you can train the models, create these data flywheels where you're taking the output of the model, you're seeing the way that the business user is then tweaking that output, and then you're funneling that tweaked output back into the model to improve the output over time. So one example of that data flywheel would be Jasper, right? And this is actually a horizontal platform, so it's not perfect, but as an example, but like they work with tons of the Fortune 100. So if you've got like, let's call it randomly like 50 of the Fortune 100 using your platform for their marketing content, well, now you've got data on what outputs the Fortune 100 are using for their marketing content, but also like what platforms are they piping it into? How are they taking that output, tweaking it, punching it up, whatever? And all that data can then pipe back into their model and make the model output the next time around even better. And that creates this huge advantage and this huge moat. So like one of the things that I get excited about in addition to the verticalized AI applications is like anywhere that you can create that data flywheel, because I think that that creates a moat that, you know, any company now could technically just use the ChatGPT API and build a marketing copy automation solution, right? You give it inputs, it gives you marketing copy outputs, but what you'll find is like the outputs aren't that good. That's because they haven't been fine-tuned. There's no way for them to be specific to a certain subset. And so that's a huge advantage that someone like a Jasper has. So how that feeds back into the verticalized opportunities is like a good example would be ERPs, right? Enterprise resource planning, right? It's how they do a lot of their procurement. It's how they plan out, project manage a lot of things. And right now the players are pretty horizontal, right? So like Oracle has an offering. There's some certain other offerings for different specific types of businesses, but they're all like 40, 50 years old. And so that's an industry where, because there's a lot of data sets that are specific to like chemical manufacturing, you can then build a system that collects all that inputs and then does that job of the ERP, but leverages a lot of these new AI features and a lot of new AI workflows and also that data flywheel to create outputs that's very specific to that use case in that industry. I think those are really big opportunities. So that's kind of the way that I see the AI landscape. Those are some of the opportunities that I'm excited about. And I just need to like emphasize also that this, again, all comes down to finding that one founder that you're able to take an execution bet on, where you're like, look, I've watched you execute over enough time, and I, you know, buy into your very deep thinking and your ability to actually take a plan and then go execute on that plan and create business value. And now I want to like back that to the next level. Like, because all these other things I talk about, business model, data mode, hyper verticalized platform, like none of that matters if you don't have a really impressive founder and founding team to go take that opportunity and then turn it into a big company.
Jake, this is like a crash course on VC. I'm so thankful for this episode. I'm genuinely myself learning so much from you. You just going back to rewind back a bit to the funding part, because you've been involved in funding aspects of VC very significantly throughout your career. What what early stage founders really need to focus on when they're trying to raise their initial funding? Is it because some people say it's the pitch deck, right? Some people say it's really like the team that the VCs look for. And obviously different VCs look for different things. Some people say it's like the product demo, right? You really have to have it. What are you saying the early stage founders really need to focus on?
Yeah, yeah. What are the things that you should focus on as a founder trying to kind of raise VC funding? Um, I think if I had to kind of encompass a bunch of different points into one thing that founders should focus on, it's their story and their storytelling, right? Going back to like what got me into this in the first place, debate. It's all about telling a story, framing your position, and framing the way that other people interpret it and think about it. And I think there's a lot of corollaries there to raising funding as a startup. So you need to have a really clear story on first, like what's your business, right? What's the big opportunity that you see? What's your unique insight? How did you, come up with this idea? What have you done so far? Like being very, very clear on the story of the business. Second, being super clear on the story of you as the founder, right? There's lots of people that will have the same or similar ideas. What's your unique
Mm-hmm.
insight? And more importantly, like what's your spike and why are you uniquely suited to do this? Because there's a bunch of different people that are going to have the same idea. Why are you going to succeed where they might not? Right. So telling your own personal story, your own personal attachment to the problem, to the space, to the solution, whatever that may be. And then the last aspect of storytelling is your fundraising story and your fundraising narrative, right? Which is really just, you know, where have you gotten so far? What metrics or traction has that created that will validate that, hey, you're on the right path? And then how are you going to take this funding and use it to get to that next stage or next inflection point as a company? How are you going to take my $2 million that you're raising for your seed round? How are you going to use that to drive the KPIs that you need to raise a Series A round? And what activities are you going to use to do that? Having really, really clear answers on all those questions and being able to encapsulate that in a really enticing and exciting story or narrative is super important. And I think on the fundraising storytelling side of things, you need to tell one, what's the play that you're running? What's the product? Who are you selling it to? And then like, what's the evidence that that's working? And that if you have capital, you can pour fuel on that fire and make it work even better. And then two, like, what's the adjacency that you're de-risking, right? What's on top of what you're already doing that's working? What are the other things that you're going to use the capital for to de-risk to either offer the same products to a different customer segment or offer the same customer segment a different product or a different feature set? And then how does that make the business more valuable long term? So I think storytelling ultimately is what founders need to understand. And they need storytelling about them and why they're the right founder and the right team. They need storytelling around the business and the market. Why is this the right time to build this? What's your unique insight to this market? And then three, they need a story of like, what is their fundraising narrative, right? How is the capital that they raise now going to let them double down on what's working and start building business value and put them in a position to make the business even more valuable long term?
Um, Very interesting. So when founders come up with that initial number, right? Should they approach that initial number to, obviously you can account for all the expenses, right? You can have a very detailed business expense when you're just starting out, but also you want to have enough money to provide also some cushioning in case things go wrong and you want to give yourself enough time. How they should approach that initial number?
Yeah, it's a great question, and this is also a common mistake I see with founders when they're fundraising. The difference between raising 500K and 1.5 million is very, very steep. One type is probably better suited for a specific type of investor, namely pre-seed funds and direct angel investors. The other, you probably want some sort of institutional backing, whether that's like a larger pre-seed VC or even like a seed stage VC. And with both of those, they have different ownership targets from a VC perspective. They have different expectations in terms of the exit value, in terms of subsequent fundraising, et cetera. So to answer your question, like how do founders figure out how much to raise? I actually built a tool and a template for this. It's just a basic spreadsheet though. Like what you need to do is you need to estimate your expenses and then you need to figure out, okay, based on my projected growth rate, right? Like let's assume that I have the money that I need for this burn rate a month, call it like 15 grand or 20 grand a month, right? How long is it going to take me to hit, if you're like a seed stage founder, call it like 1 million or 1.5 million in annual revenue, right? Then if you've got the spreadsheet and you've already mapped out what your projected burn rate will be, you just look at what that number is. And that starts to give you the ballpark number of how much you need to raise. Because again, your fundraising story is, hey, I'm raising this much money. With that, I'm going to get to these KPIs, one of which is like $1.5 million in annual revenue. And then there's other stuff depending on the type of business you are, right? I'm going to do it by doing these strategic things. And then at that point, I'll be in a great position to then go raise my Series A, right? So you kind of back into the number, right? You figure out what are the outcomes or metrics that you want to hit to kind of be that next inflection point as a business. And then working backwards, how much capital do I need to hit those metrics and those benchmarks, plus like 3 or 4 months? Because to your point, things never really go as planned. So what I advocate for is like, create some sort of financial model. Like you need to have faith in the numbers. It doesn't have to be sophisticated, just like baseline assumptions of what's your average contract value? How many customers can you reasonably close in any given month? And then how long is it going to take you to build out the feature set necessary or to get enough customers to where you hit that next inflection point as a company? And then you just back into what your burn rate should be. And that will give you a number that's kind of probably pretty close to the ultimate number that you want to end up raising. And then you can start tweaking it as your assumptions are either validated or invalidated, or as you start having conversations with VCs. Because I think the last thing that a lot of founders don't really understand is that if you're raising money from an institutional VC, and by institutional, I mean that the VC fund like Antler, we raise our money that we invest in startups from our investors, which are called LPs, limited partners. And every fund that raises money from limited partners has what's called an ownership target, right? Which could be very specific, like we want 12, 15%, or could be general. We want anywhere from like 8 to 15% for anywhere from this check to this check. This is essentially their strategy as a fund, right? So for example, when I was at Foundation Capital, they were looking for close to 20% ownership on their initial investment. So what that means is that if you're a founder and you only need to raise 500K and you're not willing to sell more than, call it 10% of your company to get it, well, even if you are a really great fit on paper for a Foundation Capital, just doesn't make sense for them to invest because they can't own enough of the company for it to fit with their financial model and their fund model. And so it's really, really important to have a clear understanding of what that amount is. And then also how much dilution you're willing to give up as a founder, because that helps you bracket into like, okay, I should raise from a bunch of angels, or okay, I should look at corporate VCs or family offices, or okay, I really need to raise institutional venture capital and I need to raise this much because of the valuation that I want. That's the only way that VCs can get a big enough bite for it to make sense for them to make the investment.
What you saying? What do you think is a sweet spot for ownership?
I think all founders should plan and anticipate, at least in those early funding rounds of call it like through Series A. At Series B and beyond, it gets a little bit more fuzzy, but through Series A, like budget and anticipate for selling about 20% of the company.
20% of the company.
Right? And sometimes that can go higher, sometimes that can go lower. One benefit of mapping this out on a spreadsheet is you can actually like analyze. You could say, okay, if I raise another $500,000 now, that will dilute me an extra, call it 5%. But with that extra runway, now when I raise again, I can only sell 12% of my company because my metrics are better, right? So for the amount when I need to raise again, now I can only sell 12% versus 20%. So I'm actually net, I save myself 3 points of dilution because I raised a little bit more now. I diluted a little bit more now so that I can dilute less in the future. So I think benchmark, always anticipate around 20%. Once you get past Series A, those numbers flex a lot. And in terms of ownership targets of VCs, some are fairly high in kind of like the 20% range. Others are a lot lower. Maybe it's like 8 to 10%. I'd say rule of thumb, expect like 12 to 15%. And if you want to really just be conservative, expect 15%, because then that helps you kind of benchmark and ballpark. But for founders, like the advice I'd give is ask, right? There's no like secrets to this. Some people or some firms will give you like a very definite answer of, oh, we need at least this percentage, in which case, great. Now you can kind of like do the math backwards of, okay, so their check size is $1 million on average. And if they want 12%, that means that they're valuing the company usually around like $8 million, right? That's just quick back of the napkin math. But yeah, I would say like for founders to expect, especially in the pre-seed and seed round and probably Series A as well, to sell between 15 and 20%, just budget for 20% to be safe. And then for like from the investor perspective, they're usually looking for between 10 and 20%. Usually like 12 to 15 is what I've seen is more standard.
This is so interesting to me. Um, And as you said, you already touched upon that. Most VC firms invest at different stages, right? From seed to Series A, Series B, Series C sometimes. Um, uh, what key metrics do VC investors look for in evaluating? Like what performance factors, what growth signals they look for? Is it because sometimes startups keep earning revenue, but they're not making any profit for a while, right? So what they really focus on to decide whether to make a follow-on investment or not?
So for follow-on investment, a lot of that comes down into details of like, do we want to buy up more ownership? Do we want to maintain our existing ownership? Or are we okay getting diluted down if this company raises more money? I'd say in terms of like, so it's hard for me to speak to that because every firm has different
Of course.
strategies for how they
Yeah.
approach that. I'd say for what founders should expect in terms of like metrics, benchmarks, milestones for the next round of funding is like, here's my framework. When you're raising pre-seed capital, you're raising to like build your initial product, get your first few customers, and build conviction in that customer desire value prop loop. That's kind of what pre-seed funding is for. What seed funding is for is, okay, you've got conviction in that core loop, you've got an early product. Now you need to find product market fit, which means you can sell it repeatably, predictably, and scalably. If I put $10 into these channels, I get $11 worth of sales out of these channels. That's your goal, right? You're not supposed to be there when you are raising the seed. That's what the capital is there to help you find out. The
Mm.
capital is help you turn that like, okay, I've got a product, I've got a customer segment. Now turn that into a repeatable, scalable sales process. Then in Series A, that's when you pour fuel on that fire of the repeatable, scalable sales process, and then start increasing and entering these adjacencies, right? Which is like, okay, well, now let's add this module that we can upsell, or now let's start selling a similar product to this customer segment to expand the market size, things like that. In terms of benchmarks and what people look for, the pre-seed stage, it's really all about the founder, the team, and the market, right? So who's your early team? Is this market really big? Do you have a reliable way of getting in front of your early customers? So you can start like figuring out what to build. And then once you've built like an early version, start selling it. For seed stage, most firms are looking for a few hundred K in annual revenue, meaning that you've validated that core loop. And now it's just about kind of taking that product to market and figuring out that repeatability, as well as a lot of analysis of like the founder and the market. Is this big enough? At Series A, the benchmarks would be, it used to be like $1 million in annual revenue. Then you can go kind of raise some kind of Series A. I think that the market's gotten a little bit more difficult actually. And so now Series A investors are looking for, more revenue, like 1.5 million, 2 million in revenue. One thing to keep in mind though, for all of this is that in terms of metrics, it's a balance between like the overall number. So let's say total revenue and the velocity. How quickly did you reach that overall number?
Mm.
So a company growing 30% month over month at 100K of revenue is maybe more interesting than a company growing 3% month over month with 500,000 in revenue. Because if you play that out over time, you can see that, within 12 months to a year, that company growing with much higher velocity is going to dramatically overtake the company with much slower velocity, even if it's at like a higher total number right now. So that's always a dynamic to keep in mind is like, what does the velocity look like relative to the total numbers? And that's going to influence the benchmarks that investors are looking at. Beyond that, it's tough to give specific answers, but yeah, I'd say a few 100,000 in your seed round and, over 1 million in Series A, ideally closer to like 2 million. But in terms of what investors are evaluating, I really strongly believe that pre-seed, its team, its market, its ability to get in front of that market and build something they want. At seed, it's, conviction in that core loop, and then figuring out how to take this product and sell it repeatably. And then in Series A, it's can you pour fuel on the fire and double down on what's working? And then what are like these other adjacent markets or products that you're going to start testing to increase the overall value of the company?
Jay, one thing I really appreciate your answers. You summarize your points at the end, which really helps me to stay on track. That's super
That's the
great.
debater in me, right?
Yeah,
You gotta summarize at the
I'm
end.
super grateful for that. This was a very informative episode. I think I'll have to rewatch it like one more time to really fully grasp everything you said. It was fascinating. I don't want to waste too much of your time, so I'm gonna ask my final question. For people, for the founders who really want to start a company, and what I get in a space. What advice do you have? What general advice do you have, and how they should move forward?
Yeah. Piece of advice number one is just get started. And usually what that means is talking to customers, right? Start interviewing your potential customer and make sure that you're interviewing, trying to understand their problems and not coming in like asking if they like your solution. You're not going to get good answers that way, but to get started, just like start talking to customers. You can do one a week, you can do five a week, like whatever time commitment you can spare, start talking to customers. And ultimately that's going to help you build the conviction to leave your day job and go full time in this. Is all right, I've talked to like 100 customers now. I feel really strongly that this is what they want and I can deliver it to them this way. Now, once I start building, I can reach back out to those people and be like, hey, I built something that I think can solve your problem. So that's piece of advice number one. Piece of advice number two would be once you get to that point of committing, like burn all the boats, quit your job, go all in. The reason that's important is that you're never going to build anything. Anything we're doing is really fucking hard. And you're not going to ever be able to commit the time necessary to build something worthwhile or huge unless you kind of burn all the boats and go all in with that. So those are my pieces of advice. I do need to jump. I think the last thing I'd say is that if founders are thinking about starting a company, would love for them to consider Antler as a great option. We can provide them with founder community, a lot of coaching, helping them go from just like idea or general space to actual functioning business and early customers. We can also then provide them with their first funding so that they can continue working full time on it. You can apply anyone at any time, www.antler.co, but also hit me up on LinkedIn, shoot me a DM or shoot me a connection request.